I do have Bill Winters, the Group Chief Executive of Standard Chartered, right here with me. Bill, it's great to have you in the show. Thank you very much for your time. Let me start off by understanding Standard Chartered's approach towards investing in upcoming fintech ventures, right? You have a very unique approach. You essentially are buying stakes in companies that have done a proof of concepts. So explain a bit about what your game plan is with regards to perhaps, kind of separating yourself from other major financial institutions in building that business.
I think we do have a somewhat unique approach. Buying stakes in fintech partners, typically people that we have an extensive relationship with, that's one part of it. It's an important part. Probably more important is the digital banks that we're introducing across the world. So we've now launched 8 digital banks in Africa. I think the only bank that has that kind of a network across the African continent, both in markets where we have a retail banking business today, but also in markets where we don't. We were one of the first banks to be selected for a license in Hong Kong, to one of the virtual bank licenses in Hong Kong. We're building that now, hope to roll that out in the early part of next year. In that case, we're going in partnership with Hong Kong Telecom and C-Trip. And the idea there is to take a new bit of technology that we're building from scratch and to deliver that to not just to the clients that we can target, but also to the clients of Hong Kong Telecom, obviously the largest telco in Hong Kong, and C-Trip, the largest travel agent in the world.
Right, but this digital rollout, how much are you investing in it and how much do you hope to get back in return?
So I think broadly we can say there's 2 types of investment in digital. One is improving the way that you do business today. It's sort of call it the old business model updated for the modern world. That's a meaningful component of the $1.7 billion that we spend every year on technology and investments. But that in and of itself, that's just a cost of doing business. I mean, we're going to have to offer that to our clients. In some ways, the more interesting part, although both very important, is to create disruptive business models. And what we're building in Hong Kong, we intend to be a disruptor. If we're successful in ultimately reaching some sort of agreement, and if we're chosen to take one of the virtual bank licenses in Singapore, we would also intend to be a disruptor. Now, why, you might ask, would we want to disrupt our own market, right? Because Hong Kong and Singapore are our 2 biggest markets. Because we think we can offer something fundamentally different to a subset of the population in these countries that we're not banking today. Whether it's millennials or the mass market where our market shares are actually relatively low. Okay. With really cutting-edge digital tools, we think we can disrupt the incumbents and continue to grow our existing business quite nicely.